everybody. In this video, I will show you how to answer this past year mid-semester exam question. This question is the last question in this past year exam question. So the thing that is related to this question is the accounting principle. You have learned about this accounting principle, I think, in topic 1. So let's see how to answer this kind of question. See the English version of the question. Follows are several major transactions made by M-Joy Company. For each transaction, identify the accounting principle or assumption that has been followed or violated. And for each transaction that have been violated, the principle or assumption explain what the company should do to correct the situation. I hope you can understand the English version. Maybe the English version is not the best, and is not using the best English, but I hope you can still understand. So to see the first one, so remember the question asks you, for each transaction that violated the principle or assumption, explain what the company should do to correct the situation. Okay, so let's see. This is the first scenario or situation. Malik, the president of M-Joy Company, has instructed head of accounting department to report one of the company's building in the business balance sheet at its fair value of 2.8 million instead of its cost of $2 million. He says, our company has received a purchase offer for the building and in the near future it will be sold. So what do you think? What is the accounting principle that has been violated? Okay, the answer is historical cost principle. This scenario shows that Malik has violated the historical cost principle. So the historical cost principle says, when you want to record the value of a non-current asset or any form of assets, you have to record it at the purchase price, not at the market price or fair value price or any value. You have to record an asset always at the purchase price. One of the reasons that you have to record an asset at the purchase price is you have a source document for that purchase price. So the document can be verified. So the number is an objective number. If you use market value or fair value, the number is not a number that can be verified. So read about historical cost. I hope you can. Okay, read about the historical cost. I hope you can follow the idea. Okay, see the second scenario. When preparing reports, the head of accounting department of D-Joy Company excluded 2 weeks from year 2015, making the year has 50 weeks only instead of I think 55 weeks. In one year there are 55 weeks. So the argument is that it will make the 2015 net loss looks less shocking. So this scenario shows that which accounting principle has been violated. I think the answer is time period principle. The time period principle says the life of a business can be divided into periods so that you can measure the performance of the business. So according to the time period principle, a business should close its account at least once a year. At least once a year. So in this question, in this scenario, the business close its account in less than a year. So it violates the principle of time period. I think it also violates another principle that we use in accounting. Maybe if you have heard about full disclosure principle. Full disclosure principle says a business has to disclose everything related to the account. The business cannot hide information. So that principle also is related to this scenario. But the most, I think the easiest one is the time period principle. Okay, let's see the scenario number 3. This is the last one, I think. On 31st of December, Joy sells a set of electrical products to a business that has been its regular customer. On the 15th of January, the company was able to deliver the set to the customer, and on the 30th of January, the company received payment from the customer. Malik has instructed the head of accounting department to record this transaction on 31st of December for the reason that the total sales revenue figure will be higher for the company fiscal year ended 31st of December. So, what do you think? What is the accounting principle that has been violated? The answer is revenue recognition principle. Okay, you have to read about this principle. The principle says in accounting, you record revenue when the transaction happen. In other words, or in accounting, we see the transaction as has happened when the goods is changing hand. When the goods is changing hand from the hand of the seller to the hand of the buyer. In this scenario, when is the good has changing hand? The good has changing hand on the 15th of January. On that day, the seller has delivered the product to the buyer. So the good is changing hand from the hand of the seller to the hand of the buyer. At 31st of December, the company maybe just got an order from the customer. So the company got an order from the customer at 31st of December. The company delivered the product to the customer on the 15th of January, and at the 30th of January, the buyer paid the purchase to the seller. So if the company record the revenue at 31st of December, it violates the principle of revenue recognition. According to the principle of revenue recognition, a business has to recognize revenue when the transaction happen, or when the good is changing hand from the hand of the seller to the hand of the buyer. Okay, this is the end of the video. Thank you very much.